Good evening, Ms. Sarah and my fellow classmates. My name is Usha Devi. The case study about Blades Company, I am going to present about the introduction part. There is three issues. The first one is the Asian case impact on Blades. The second was is the government intervention, and the third one is the impact of a fixed exchange rate. So the Asian PC had impact on the Blades because of the poor economic conditions in Asia, particularly in Thailand, which might cause a foreign investor to pull out of the market and creating a shortage of Thai baht available for purchase. Due to Blade's net inflow of Thai baht put downward pressure on the baht's value, which might have a significant impact on company profit margin. Secondly, the effect of government intervention. Through its intervention in the foreign exchange market, Thai government tried to stabilize their value of baht. They utilized their dollar reserve to buy baht and exchange them to the baht reserves. Their involvement was unsuccessful through a 3 month period. The value of baht fell drastically when compared to US dollar. This raises about issue about the efficiency of government action as well as how it affects Blade's daily operations. The third one is the impact of a fixed exchange rate. Because the Blade just started selling the rollerblades to Thailand and have a deal in a place with a Thai importer, a set of number of Thai baht has been included in the agreement for each pair of rollerblades. However, the price of rubber and plastic imported from Thailand depends on Thailand economic situation as well as fixed exchange rate fluctuations. In this case, the challenges faced by May due to the Asian crisis and its impact on the value of Thai baht. It has a significant effect on the company profitability as well as decision to open operation in Thailand. So, moving on the next question. Did the intervention effort by the Thai government constitute direct or indirect intervention? Is classified as a direct intervention. Direct intervention refers to a measures taken by government to directly influence the exchange rate of its currency. In this case, the Thai government intervened in the foreign exchange market by exchanging baht reserve, intervened in foreign dollar reserve, and using the dollar reserve to buy the baht in the foreign exchange market. This direct measure was aimed to stabilizing the baht exchange rate and preventing the further depreciation. The Thai government's intervention led to active buying and selling of the currency in the foreign exchange market, which is directly affect the supply and demand trend for the Thai baht by converting the baht and help support its value. This direct intervention was in response to an oversupply of Thai baht caused by the economic downturn and then withdrawal for foreign investors from Thailand. It is important to note that direct intervention is characterized as a government actively participating in the foreign exchange market.
Hi and Assalamualaikum to Ms. Sarah. Today, my group and I will present about our assignment, International Financial Management, Case Study Analysis, Blade Company. My name is Diana Bakis. For first presenter of our group, I will pass to Usha Devi. I will present for the next question, which is, did the intervention by the Thai government constitute paralyzed or non-paralyzed intervention? The intervention by the Thai government can be classified as non-paralyzed intervention in attempting to stabilize the baht exchange rate. The government swapped baht reserve for dollar reserve and used the dollar to purchase baht in a foreign exchange market, and the government did not take stimulus action to offset the impact on the domestic money supply, which is Thai baht, and the subsequent decline in the baht value over 3 month 3-month period, that intervention was not successful, and the market forced overwhelmed the government effort, and this lack of success could be due to the absence of stabilizing measure to counterbalance in the intervention impact on the domestic economy. And if the government Thai has conducted the stabilized intervention, it will be to aim to stabilize the baht exchange rate while also offsetting the impact on the domestic money supply. So, if the Thai government might take the stimulus action, such as conducting open market operation, it could be both domestic. It could be like both a domestic aspect, like government bond, injecting an equivalent amount of baht back into the domestic economy, and this can be stable the exchange rate without allowing the intervention to direct effect to the money supply, and it could help in inflationary pressure and interest rate. And for the third question, which is explain the differences between the sterilized and non-sterilized intervention. What is sterilized intervention? Sterilized intervention is a central bank or government intervene in the foreign exchange market to influence the exchange rate by the offsetting action to neutralize the impact on the domestic money supply. While for non-sterilized intervention, the bank or government does not take offsetting action, allowing the intervention to directly impact to the domestic money supply. And for the sterilized intervention, which is then not involved not only buying or selling of the foreign currency, but also additionally monetary policy action to offset the impact on the domestic supply. And they aim to maintain the stability in both exchange rate and the domestic money supply. And the business may face less uncertainty in their international transaction, as the intervention is designed to avoid inflationary or deflationary pressure on the domestic economy itself. But for non-sterilized intervention, this involves direct buying or selling of foreign currency without stimulus action to offset the impact on the domestic money supply. And the impact on the exchange rate more to direct, but market force may overpower the intervention, as seen in the case of the Thai government unsuccessful attempt. And the exchange rate fluctuation may have more direct and unpredictable impact on the business and investor, and require carefully considering all of the potential volatility in a cash flow. For the next question, I'll pass to next presenter.
Hi, my name is Muhammad Daniel Hakim, and I'll be answering question number 4 in this case study, which is the question given is if the Thai baht fixed with respect to the US dollar, how could this affect US level inflation? A fixed exchange rate is where the value of a country currency is set to the value of another currency. Under this fixed exchange rate system, inflation can happen in one country can spill over to another country. For example, if Thailand experience high inflation within the system, Thai consumer might shift their buying habit towards US product, and US consumer might decrease their purchase of Thai product. This shift could reduce the level of production in Thailand and will be leading to unemployment. It also can drive up inflation in the US due to increase of demand of American product. Because of this, the inflationary impact in Thailand could face into higher inflation rate in the US. This scenario could significantly affect companies like Blades in our case study, particularly as their production costs increase, their production costs increase while they continue exporting at fixed price. Thank you.
Hi, my name is Kisana Ausumi Zulkifli. I'm from Bachelor in International Business. Going to present for the next slides, which is the question 5, which is how are the companies such as Blades affected by a fixed exchange rate? So first of all, the first point is the uncertainty created by the unsuccessful government intervention and potential future fluctuations, which is the explanation is it can add the further complexity to Blades for the financial management decisions. And then for the next point is the international market competitiveness, which is it means like Blades product may become more like costly for overseas consumers because of the fixed rate is overvalued. So it can be like it can affect it to make the lower demand for the company's product. And then for the next point is the engage is international trade, which is the fixed exchange rate can be affected based on the company operates in country which is the fixed exchange rate. As we know, the fixed exchange rate is based on the governments, and then also the value of the local currency is set relation to another currency. Like for this, the tax is about the Thai baht. So because of this, stability can provide some predictability for pricing and budgeting, which is as the exchange rate can remain constant. The last question is about how are the companies such as Blades affected by freely floating exchange rate. So the first point is allow the currency's value to be determined by market forces, which is it means that it's reflecting the supply and the demand dynamics in the foreign exchange market. Since freely floating market is like depends on the market itself rather than focus on from the government and the central bank. So for the next point is the pricing strategies become more complex. It means because Blades actually may face challenges in predicting future, may face challenges in terms of the cash flow and the budgeting, because in the tax it's still like Blades lies about the company's increased volatility and uncertainty. And then lastly, the next point is it can increase the volatility and then uncertainty, which is the exchange rate fluctuations can impact the cost of imported components, affecting the production costs and the profit margins. So for the next part is about the exchange rate movement. So our group, we decided to choose a USD, which is the US dollar, and then GBP, which is the Great Britain pound, for our currency rate. For next, I'm going to explain about the comparison between USD, GBP, USD and GBP daily changes. So based on the slides, we can see for the firstly about the USD daily changes. Firstly, the USD value fluctuated throughout the period, showing both a negative and positive sides. We can see there are many rising and falling for the daily changes. And then for the daily percentage is ranging from the negative 0.6% to 0.76%. So for the overall, the USD experienced fluctuations, but the trend did not show a constant direction because, as I mentioned before, there are rising and falling for the daily changes from the early and until at the end of the year for the USD. So the comparisons between the daily changes in USD and GBP values reveals a lack of strong correlations. So based on the graph, for the daily changes for USD on 24th November 2022, we can see it is the lowest, and it made the USD falling because of the dollar slip against a basket of currencies on Friday, because based on the news from US, the business activity and the private sectors set the employment decline in line with expectations make the economy going slow down. And then next is because of the factors of why USD falling because of the traded relatively narrow range in the US market closing early because of the Thanksgiving holiday. So that's why the currency is falling down. And then next for the on 25th April it rises based on the graph because of the China's yuan currency is falling due to the COVID-19. So the US is actually make it rises because of the daily percentage gain since the last March. So that's why. So that is the reason why the USD can high and going down. So next I'm going to explain about the GBP daily changes. So it can, as we can see, there are many rising and falling for the GBP daily changes, which is we can see there are a lot of different. So first of all, similar to the USD, GBP value exhibited fluctuations over the periods, which is the daily changes range from the negative 1.94% to 2.07%. The GBP also did not follow a consistent trend, and its value varied on day-to-day on the daily basis. So based on the graph, that if you look on the September 2022, it was the highest rising in GBP rate, which is make it very obvious compared with the USD or also the other daily changes currency. The reason why it's rising because GBP rates, the sterling rising around like 8% that made GBP more stronger. And then on 26 September 2022, the GBP is falling because the British pound hit all-time low against the US dollar, following the new government move to the tax cuts, which is because of the, it's also make it like a political issue that affected the GBP currency, and that's also because the investors rejected the British government to invest because they did not want to get a risky because of the economic strategy that made the GBP going low and down. So that's all from me. Thank you.
Next is comparison between USD and GBP monthly changes. For the first currency, I will explain about USD monthly changes. And as you can see from the graph, the highest appreciate from the USD is in October 2022, which is the value is 0.0328 and indicate the increased demand or positive estimate to the currency during that period. And the reason why USD appreciate during the October because USD is generally considered as safe haven currency. So in time of hectic global economy and geopolitical uncertainty as a global investor seek to limit their exposure to riskier currency in favor of the USD. For example, following the invasion of Ukraine by Russia on 24th February 2022, the USD index rose by as much as 80.6% to 30 years high of 140.1 on 12th October 2022. And before ending year of 2022, USD gained at 8.2% at 103.5 at the end of December 2022. And the deficit from the USD, as you can see, is on November and December, which is the value is negative 0.016 and negative 0.0445. As my reference from JP Morgan report, the historic bull run last year, the nominal dollar index fell almost 7% between November 2022 and January 2023. Such a weakness reflects a mean reversion from the dollar outside gain in 2022. And that is the currency from GBP. As you can see, the GBP depreciate on the lowest appreciate from GBP is in September. So the reason why the GBP appreciate during that time is because the little optimal for the rest of the year as growth expectation weaken again, and sterling fell 3.75% against the dollar through the month, logging a decline not seen the end of last summer. And at that time, the UK currency was rocked first by political and economic uncertainty, then by the short-lived mini budget, and now by the former minister Liz Truss, which pushed the sterling to a record low. But from the evidence, GBP appreciate more than the September. On October, which is the appreciate amount is 0.0291, and the reason why they appreciate is because the pound because the USD has weakened over the same period, and this may account for 50% of the change in the pound. Yet the pound has also gained against other currency like euro, rising from about 1.08 to 1.17 over the same period. And this the pound appreciate more likely due to UK policy than foreign factors. And lastly is the standard deviation. This is a standard deviation between USD and GBP. As you can see, the USD standard deviation is 0.143%, while for GBP standard deviation is 0.17%. And this is the standard deviation formula to calculate and get the result of standard deviation. And a lower standard deviation is indicate less volatility and a risk, and therefore, based on the provided value, GBP has bit lower volatility compared to USD, and lower volatility is generally considered as favorable for investor or entity seeking stability and predictable in a currency movement. Lower standard deviation is a better investment for investor. So, we choose GBP for consider a better term of lower volatility compared to USD. Thank you. That's all from